Hi, welcome to another edition of It's Not Rocket Science. I'm Don Carriker with IWantAGreatHomeLoan.com, and I'm here to teach you what I can about how the best way is to understand mortgages and how they work and how to get the best mortgage for your money. Today we're going to talk about mortgage debt-to-income ratios. And all that means, you've heard that term before thrown around, oh, your debt-to-income ratio is too high, you can't get a house. What does that mean? It means, very simply, take your debts that are on your credit report and any private loans you have, and you divide that by your gross income. Now let's talk about that. Your debts are not counting things like your cell phone, your electric bill, your insurance, nothing like that. It's strictly installment type debts or credit card debts, anything you might have. You've got things that show up on your credit. Or if you have a private loan with Aunt Edna, for $50 a month for something, we do have to count that. Now, income is very easy. That's the gross income that you would love to take home, but you don't get to because the taxes have to be taken out after that. So make sure you use your gross income, and that's the biggest number that you have on your paycheck, and that's on a monthly basis. So you want to use your debts divided by your income. Let's do an example so see how you understand that. Let's start off with your debts. And let's say you have a car for $250 a month. And student loans, let's say, a lot of people have student loans, $100 a month. And what do you have? Credit cards? Probably, yeah. So that Lowe's card that you use to buy all your stuff and your tools and everything. So credit card, we'll say, is going to be $50 a month. And what else? Gasoline. That's a big one. Practically have to get a mortgage just to get gas. So how about gas card for $100 a month? And that's pretty typical what people might have on their credit report and the debts that they have. So $250 plus $100 is $350, $400, let's say $500 a month. Now, that's your debts right here. You figure that out. Your income's pretty easy. You ought to know that. Income. Now, that's from everybody that's going to be on the loan. So if you have a husband and wife and they're not both going to be on the loan for whatever reason, you can't count both their incomes. You can only count the income of the person on the loan. So let's say realistically, one person's income is $2,500 per month, and then the other person's income is $1,500 per month. So that gives you a total of $4,000 per month. Now I know a lot of people have income from child support, separate maintenance, things like that, retirement accounts where they get money from that. You can count that on your debt-to-income ratio. You can count child support, alimony, separate maintenance, money that you get on a monthly basis that you've been getting for years, maybe a settlement or something, things like that. You can count that in your income. The things you can't count on your income, for example, are part-time income that you haven't been doing for at least 2 years. Has to be 2-year history. Self-employment income, can't count that unless you've had proof of it on your tax return for 2 years. So that's the government's way of making sure that self-employed people aren't able to get loans anymore. Those stated income loans and the income loans where you didn't need much documentation, those are gone. So you've got to be able to prove your income, and typically it's with 2 years tax returns and W-2s if you have them. So we've got our debts of $500 a month right there. You got your income of $400 a month, or $4,000 a month. Now that's not your debt-to-income ratio yet that you want to figure, because remember, you've got a house that you're wanting to buy. So let's use an example of what a typical house payment might be. Okay, let's say we're buying a $175,000 house. And we just so happen to be getting a 100% loan that we have available. So $175,000 house, and that payment just on the house alone, we'll say will be, let's say $799, because the rates are really good right now, and that's about what it would be like for a typical loan. That's per month. But you can't forget the tax man and the insurance man. So you've got taxes on that property, and that's going to run you probably, I don't know, we'll say $150 a month. And then you got insurance. I call that HOI, homeowners insurance, and that's going to be, on that price of a house, I would say probably $100 a month. Okay? And then if you have a typical loan that does not have 20% down, more than likely you're going to have something called mortgage insurance. Now you may have heard of it called PMI, MI, MIP, all sorts of different words for it. It's the different types of mortgage insurance that's out there. But for our purposes, we're going to assume that we're going to be buying a house, and one of our favorite loans for this area is a rural development loan, and that has a very small amount of mortgage insurance. It ends up being about 0.4% of the loan amount per year divided by 12. So in our example here, we're just going to call it MI, and we're going to say that's going to be about $60 a month. Okay, so we got to add that up. $799, I'm just going to round to 800 so I can do it in my head. So 800, 950, 950, 1050, and then plus another 60, be about 1110. So 1110 per month. There you go. So for that house, to buy that house, you've got $799, well, $800, like I said, I rounded that off. $800, $950, $1050, $1,110 per month that you'd have to add to the debts that you normally pay every month, $500. So what is that? That's about $1,610. So let's go ahead and flip the page. Remembering we've got 110 plus 500. That'll be our debts. I'm going to put all debts equal $1,610. Our income, all income, equals, we said $4,000, right? So if you take 4,000, take that 1,610 divided by 4,000, that works out to be 0.4. Okay, that equals 0.40. Now, if you remember back to high school, that means 40%. That's 40% is 0.40. So you've got a 40% DTI, debt to income ratio. Now, that just happens to be within guidelines on most loans. The limit, not the limit, I shouldn't say that, the guideline is 41% for most loans. So you can do this at home. Take your income and your debts, add them all together like I showed you, divide them out, and you'll get a decimal. All that is your percent. So in this instance, you've got 1,610, including the house payment, plus divided by 4,000 in income. That gives you 0.4, which is 40% debt to income ratio. Guidelines are usually 41%. This person in this situation, they qualify based on just the debt to income ratio. Now, you have other things you have to have for qualification: job time, provable income, make sure that's provable. You have to have good credit, and you have to have ability to repay, no issues on your credit report that are major, like foreclosures or anything like that. But this, we'll talk about that later. That's more not rocket science stuff. Really easy to understand. But for right now, that's your debt to income ratio. That's how it works. And we will see you again on the next edition of It's Not Rocket Science. Have a great day. We'll talk to you later. Bye-bye.